Hello and welcome to Live Wire Markets. My name is Chris Conway. Today I'm joined by Craig Schloeffel from Payton Capital. Craig is the Head of Investment here at Payton and he joins us for Live Wire's 2023 Income Series for no doubt what will be a fascinating conversation. Craig, thanks so much for joining us today as part of Live Wire's Income Series for 2023. Looking at your current investment opportunities, they span different states, regional, suburban. What are the common characteristics that they share?
Yeah, at Payton Capital, we describe ourselves as a mid-market lender. And what that means is that our typical debt size that we have is between 5 and 50 million. The typical characteristics of our projects are we've focused on the residential space for the last couple of years, particularly now. And that's meant that you'll see a lot of residential development, and that looks like greenfield sites that have a development application in place or are almost at development application stage. It could be greenfield lots under construction, or it could be a good mix of residential housing, apartments, townhouses, etc. The other thing that you'll note with Payton Capital is we do focus on the eastern coast of Australia. So our projects are in Victoria, New South Wales, and more recently, southeast Queensland.
Craig, let's talk interest rates. It's the big topic at the moment. What is your current view on the interest rate cycle? Has the RBA gone too far?
Yeah, well, certainly the question all Australians are asking. And we certainly did think that the interest rate cycle was near the top until the most recent jobs data came out and it was very strong. Inflation is something that hurts all of us. So the RBA has a very tricky job to try and balance inflation and the needs of everyday Australians.
And Craig, how is that impacting the type of investments that Payton is offering your clients?
We've had a tilt towards residential property for quite a time now, and certainly there's persistently strong demand in that sector. So we are focused and will continue to focus on the residential development sector.
Craig, what's your view on the economy?
Yeah, it's an interesting state right now. We've got some mixed signals in the economy. If I look at things like very high inflation, interest rates rising the fastest on record, you'd say we're in a bit of trouble. You counter that to property prices starting to increase, record low jobs numbers, and yet the overlay of that is consumer confidence at all-time lows. There's some very mixed signals in the economy right now.
The RBA revealed recession modelling as high as 80% probability. How would a recession impact the demand for non-bank lending?
The great thing about non-bank lending or commercial real estate debt is that it's uncorrelated to other asset classes. So we've found through multiple market cycles that you can still safely invest in our asset class. We believe even if Australia does hit a recession, the mix of lack of supply of property, expected rate cuts early next year, and record immigration will give some real tailwinds to the residential sector.
Craig, what is unique about the Australian property market and does it provide any shelter for inflation?
The Australian property market is uniquely positioned within the Asian region, and for that we've got a huge demand of people trying to come into our country, particularly skilled workers which bring with them money, great skills that they can add to the economy, and they all want a place to live. So what we've found is that the huge immigration expected into the country in the next couple of years will certainly bring with it a demand for residential property particularly, but as people find places to live, we've got to create places for them to work, and that brings with it obviously other commercial and industrial and therefore retail spaces. So the whole property industry benefits from new Australians.
Craig, in a recent update, you talked about migration being an important factor for the property market. Can you just elaborate on the thesis there a little bit?
Yeah, well, the ABS has recently put data out to say that we're expecting 800,000 to 900,000 new Australians in the next couple of years based on the immigration data. We know from that that 70 to 80% of these people are going to settle in the major cities and most of them on the East Coast. We therefore feel that the huge amount of new Australians coming will need somewhere to live. And what we also know is many will start in an apartment before later looking for a house to live. So both the apartment market in the residential space as well as the housing markets to follow, so greenfield markets, should benefit hugely from the immigration coming through.
Craig, between 2019 and 2021, non-bank lending rates were as close to bank lending rates as we've probably ever seen. Spreads have since widened, as wide as 400 to 600 basis points over bank. What's your view on the forward outlook?
Yeah, certainly during the pandemic, we saw a huge influx of capital to our spaces. Bank rates and therefore depositing rates fell to almost zero. Investors were looking for a great place to park their funds and get a risk-adjusted return commensurate for this. Since rates have gone up, and as we know, they've gone up the fastest on record, investors are now looking at our market and saying, is there an appropriate risk-adjusted return? Spreads have widened off bank, but that's naturally a function of coming off the floor of zero and returning to the longer term average. We feel that with spreads widening, it gives investors a fantastic opportunity to once again take advantage of the risk-adjusted return in our space and also protect themselves from inflation.
Craig, you've talked about the rich opportunity set and the return profile currently available. Craig, do those returns come with any increased risk?
Yeah, risk is a really interesting concept in the private lending space because within our asset class, you've got different subsectors such as residential, you've got office, you've got hotel, you've got industrial, etc. What we have seen is borrowers have certainly come under a lot of pressure of late in the construction side because they've had increased costs of supply, they've had shortage of supply, they've had short availability of labour being very difficult to procure. What we have found though in the residential market where we focus is that the strong tailwinds of huge demand, lack of supply, overseas migration bringing in new capital and certainly new demand has meant that we feel that the residential market is going to be very strong over the next couple of years, and a well-positioned first mortgage managed well by a strong manager will provide a huge opportunity for investors to take advantage of this.
Craig, just a couple of quick follow-up questions. How much of the portfolio is currently in residential?
Currently, we've got about 85% of our book in residential.
Yep, and how long ago did you tilt the portfolio to residential?
Yeah, during COVID, we sat down as an executive team and really analysed the property market. And we looked at particularly hotel, we looked at retail, specialist retail, and we looked at the office market. And we couldn't get a clear view forward of what those sectors were going to do. And for us, we erred on the side of caution and then we took a tilt towards residential.
Your ownership structure, Craig, it's a little bit different than most fund managers here at Payton. Can you explain what that is for investors and why?
Sure. Our ownership structure is something we're really proud of at Payton. The ownership structure is 40% is owned by the Payton family, 40% is owned by staff, but what's unique to Payton is 20% of our business is owned by the Payton Foundation. And so what that means is by investors or borrowers working with Payton, whether they choose to engage with our foundation at all, they're still contributing to us providing benefit to the 16 charities that we partner with through the Payton Foundation.
Craig Schloeffel, thanks for appearing on Livewire Markets Income Series for 2023.
Thank you so much.